Hello and welcome, everyone. This is Kathleen Levito, Marketing Coordinator with AAFMAA, the American Armed Forces Mutual Aid Association. Thank you for attending today's webinar entitled Credit and More, Qualifying for a Mortgage.
Hey, Kathleen.
This monthly webinar is brought to you by AAFMAA Mortgage Services, LLC, which provides mortgages exclusively to the military community. Wherever you are looking to build, buy, or refinance a home, we can help you. This educational webinar seeks to provide AAFMAA members and prospective members with information about qualifying for a mortgage. With us today is Dale Poe, a military mortgage advisor with AAFMAA Mortgage Services, LLC. He'll be sharing a presentation on your screen, and then at the end, Dale will be able to answer any questions you might have. However, if you happen to have a question during the presentation, please feel free to type your question into the comment box on the screen, and we can answer it as we go along. And now I'll go ahead and turn it over to Dale to begin the presentation.
Thank you, Kathleen, there. On our agenda today, we're going to look at several things here. One of the ones, understanding your credit score, FICO score, repairing your credit and credit reports and looking at it. We're going to look at debt-to-income ratios. We're going to look at LTV, which is loan-to-value ratios. We're going to talk about down payments. And we're going to find out if you qualify. Next, let's look at what it looks like to qualify for a mortgage. What lenders look at? Credit reports, debt-to-income ratios, LTV, which is loan-to-value ratios, and down payment. One of the things I want to talk about, one of the advantages here, when we look at down payments, VA loans require 0% down, where conventional loans usually require 20% down for no mortgage insurance. And then you're looking at anywhere from 3.5 to 5% down for the other mortgage loan programs out there. So next, let's look at credit reports. And right here is a kind of a graph of the credit scores that most lenders look by for the FICO scores. So as we look on the chart here, you can see that excellent is really 800 and up. Very good, 740, 799. Good, 670 to 739, and fair, 560 to 669. A good low score to bare minimum score to try to achieve would be a 640. A good high score would be 740, for the best interest rates. So anything from a 640 to a 740 is really good, but you kind of want to at least get to a 640 if possible. When you're looking at the chart here, one thing that you do want to know before you really kind of get into getting a mortgage is kind of know where your credit score already is. So like, I don't know, have an idea what it is, so you know where you kind of fall in on this chart here, so you're not surprised at the end where someone pulls your credit and goes, oh, you got a 600 credit score. And they're like, what? So, the FICO scores is used by most lending institutions in the United States. So next, let's look at what goes into your credit report. Payment history is your biggest chunk here at 35%. What goes in there is, bankruptcies, late payments, collections. All that would be negative towards your payment history. Recent bad payments or late payments will hurt more than ones that were in the past, like from 10 years ago. So the more recent ones will have more of a ding than the ones from a longer period of time. As far as payment history, what helps is payments on time. So you really want to strive here is payments on time, all your payments. Debt level. And really what debt level is, for instance, would be like if you had a credit card with a Visa company and they gave you $10,000 credit max and you had $3,000, maxed on your credit card, right there you're looking at a debt level of about 30%. You kind of want to keep your debt level on your credit cards and debt like that around 30%. One of the things you could do to help that is, like, for instance, you had a Visa credit card, for instance, and your max on it was $5,000. and you have a $3,000 balance on it, you can usually call up your credit card company. You can look at the phone number on the back, or if it's through a bank that you know of, and just call them up and say, "Hey, I'd like to increase my credit, my credit from 5,000 to 10,000, available credit." So if in that scenario, if you had a $5,000 upper limit, in 3,000, 5,000 is pretty high. It's up to about 60%. If you call them up and change it to 10,000, now you're back to about the 30% debt level. So you really want to try to keep it below 30%. Length of credit history. Basically, longer is better on this. So if you had in the same scenario, if you had a credit card through Visa, and like for mine, I've had it since I was probably 20, and now I'm 50. That's a pretty long credit history on that. Try to keep length of credit history on this as longer is better. So sometimes just changing your credit card for a little bit of savings is sometimes not worth it. Inquiries. Basically, this is about 10% of your credit score, but basically inquiries in the last year have a more of a hit than inquiries like you did 10 years ago. An inquiry would be anytime you applied for credit, like you're buying a new sofa or you're buying anything and you want to apply for credit with a company, that would be an inquiry there. And one thing you kind of want to do is try to keep that to a minimum if you're even looking at getting a mortgage anytime soon. Mix of credit. Basically, that is what lenders look at there as a good mix of credit, like not all your credit is in credit cards or all your credit is in car payments. You kind of want a good, healthy mix of a little bit of everything. Next, let's look at a mortgage and your credit. Now, as we go and look at this, one thing that most mortgage lenders look at here is credit behavior. And as we touch on here, just kind of want to touch base on, let everybody know, like right now, the interest rates are at historical lows right now. So it's really a good time to do a VA IRRRL, which is IRRRL, which stands for Interest Rate Reduction Refinance Loans. These loans here, or you don't need an appraisal, you don't need all the income paperwork. They're really simple to do. And basically what you're doing is you're keeping all the information the same on your VA loans, and you're just basically reducing the interest rates since they're so low right now. So really good time to do these right now. At the same time, it's a good time to do VA cash outs or anything of that nature. Right, the housing values have gone up in the last 5 years, and now the interest rates have fallen down. So it's also a great time to do a VA cash out with the interest rates being at a historical low right now. Another thing to consider at when you're looking at doing a refi or doing a mortgage or anything like that is you also want to look at the upfront costs too. As far as the points and closing costs, just something else to kind of look at and be aware of. How lenders view your credit score. Another thing to keep in your mind here is your FICO score, along with your debt to income ratio and LTV, and what type of mortgage product will also put an impact on your credit score. What kind of credit score do I need to buy a house? Really depends on different types of mortgages, have different different credit scores they kind of require, and also different types of houses. But a good rule of thumb is around 640 and higher is a pretty good number to have. Anything in the 700s is really good, and you're looking at very favorable at most mortgage people. Next thing we kind of want to look at real quick is fixing your credit. One thing you kind of want to do is when you're looking at your credit or repairing your credit is, one, do some research. So if you're getting ready to do a mortgage and you have some questions about your credit, a good loan officer is a great source of information, especially because they look at credit reports all day long and they're used to seeing what it takes to repair a credit for a mortgage. Number two, start saving. One thing a lot of people don't realize is, you're getting ready to do a mortgage, they forget about closing costs and down payment. So then they're awfully caught off the side and like, oh yeah, and they're start scrambling at the end. start saving for that at the beginning. That really helps out a lot. Number 3, know your FICO score. Know where it should be. So, I tell people, get your free credit report. Get it from all 3 of the credit agencies, Equifax, TransUnion, Experian, and know what your scores are. And generally speaking, your credit score won't be the same with all 3. It should be fairly close, but kind of look at the credit report. Look for see if anything that's wrong. Look for anything that it should be paid off, and it's saying it's not paid off. Look for things like late payments, collections. But it's a good thing to know before you get into doing a mortgage. Is just do your credit score, do your credit report, and know your FICO score. Number 4, lower your debt to income. I talked earlier about the credit card. One thing that you could do, same example, if you have a $3,000 balance on a $5,000 credit card, you could increase your credit amount to $10,000, and right there, you lowered your debt to income. Another good way, or even a better way, is to go ahead and lower how much debt. So if you look at a credit card bill and you're like, "Wow, I owe $4,000 on that $5,000 max credit," get that paid down. Look at that and say, "Hey, I got to get that down to 30% or lower." Another thing to do is, as you're trying to repair your credit or make your credit better, is don't take on any new debt. As much as you want to get something new, or a new couch or something like that, just don't take on any new debt at all if you can help it. And really, the big one here, as far as repairing your credit or making your credit better, is pay all your bills on time every time, and get into that habit. Even if you have to make all your bills due at the same day, or pay them all the same day so everything gets paid and doesn't get left behind. But number 6 is really a big one. Next, let's look at debt to income ratio. Your debt to income ratio is really your personal finances measured how much debt you have compared to your gross income. Just so you kind of know, your debt to income, along with your credit score, is probably the 2 biggest factors in applying for a mortgage as far as getting the best interest rate possible. Next, let's look at how to calculate your debt to income. Okay, what you want to look at here is just look up all your monthly debts. Auto loans, student loans, minimum credit card payments. So if you owe $5,000 and your minimum payment is $150, use $150 as your monthly amount. Any payments out, child support, alimony, any monthly debt or obligations that you can think of that would be part of your debt. And as far as income goes, you want to look at wages, salaries, tips, bonus, pension, VA disability, Social Security. Any monthly income or yearly income would count. Child support, alimony. So when you're looking at all that, what you want to take all your monthly debt, divided by your gross income, and add in your new mortgage payment, and that would be your new debt to income ratio right there. So it's kind of figuring that out. Know what your debt to income ratio is now, but kind of figure out what it's going to be when you get the new mortgage too. Next is how do you get your debt to income? Kind of look at a quick example here. You want to add up all your payments, all your monthly payments, and add all your gross monthly income. So in this example right here, if all your debt for the month was $2,300 and all your monthly gross income, which is the big number, is $6,000, you will take $2,300 divided by $6,000, which comes out to 0.38, and you just want to times that by 100, or just put a percent sign on the end, and you're going to look at 38% would be your debt to income ratio. And really, on most of the loans and stuff like that, you want to keep your debt to income ratio 43% or lower, just depending what type of mortgage you're doing. Next is look at some other factors to consider for qualifying. Down payment. one thing to kind of consider is think about what type of mortgage you're going to do beforehand. If you're going to do a VA, or you think most likely you want to do a VA mortgage, one of the big factors here is that a VA loan has 0% down. A lot of the other loans, for instance, a conventional loan, you need to put 20% down so you don't have any mortgage insurance. The mortgage insurance is quite a bit every month. So you're really looking at anywhere from 0 to 20% down. Some of the FHA programs out there have you putting down as little as 3.5. But by far, the least down payment of all the mortgages is a VA. Another thing to kind of look at here is loan to value. Now, we'll take an example here. Let's say that you're buying a $100,000 house, and the house appraises for $100,000, and you're going to put $30,000 down, or you could be buying it for $70,000. But if your loan amount in this case is $70,000, and your house appraises for $100,000, then your LTV on this would be 70 or 70%. And next, just kind of want to go by and see if anybody has any questions or anything that I can help them with, or just.
Yeah, absolutely. Let's look at some of the questions coming in from our audience. So first up, we have a question about debt consolidation loans. Would you recommend those?
A debt consolidation loan? Mm-hmm. Sometimes they can be a good thing, but sometimes you got to kind of look into who's doing it for you. Sometimes they put in some added fees. I would try to, you could even go down to your bank, but if I was going to do a debt consolidation loan, I would definitely shop for it. I know some people do it cheaper than others. And I'd probably look up and just see what other people have to say about doing it with that corporation or that company and make sure.
Okay, good. All right, so how long does it take to repair credit?
Great question. And that really varies depending on what's wrong with your credit. You're kind of looking at a bare minimum time of around 30 days. Because what happens when you if I was to pull credit for somebody today, and you're like, oh, yeah, I can fix this late, I've already paid for this bill and it's zero balance, but it doesn't show in the credit report. Generally, you have to wait at least 30 days to re-pull credit on somebody. So you're looking at a minimum of 30 days. And then it depends on really what the credit issue is. Sometimes if you got to get with the credit people and they say, look, I've got proof that I paid that bill and it should be a zero balance and it's showing that I owe $700. You have to get with the credit people and submit the paperwork that shows that you paid that down to zero. And that could take a couple of months right there, depending on how long it takes them to research and do everything. And it really also depends on how far that your credit needs to be fixed and what it needs to go up to do a mortgage. So, but anywhere from 30 days, 4 or 5 months is definitely possible, depending on what the issue is at that time.
All right. So speaking of credit, how does a foreclosure home affect my credit, and how long would it affect my credit for?
Well, if you have a foreclosure home, it really depends on what you're applying for to do your next mortgage. Like on a VA loan, it's going to, you really got 2 years. And on a conventional loan, it could be 4 to 7 years, depending what really happened with the foreclosure. But that's another attractive feature about a VA loan. They really have the lowest time that if a foreclosure would affect that type of mortgage, which is 2 years.
Mm-hmm. All right, so here's another one that just came in. What would be the higher priority, paying down debt or building up a down payment?
Well, once again, it depends on what type of mortgage you think it best fits your needs. If you're doing a VA loan, you don't have a down payment. You can put zero down. So in that case, if you're doing a VA loan, paying down debt would be the best thing because you can do 100% financing. Um, on another type of loan, if you're doing an FHA or something like that, you got to have a certain percent down to put down on the mortgage, or you can't do it either. So it really depends on what type of mortgage. And once again, that is one of the great things about doing a VA loan or VA mortgage is you really don't need zero down.
Great. And speaking of the VA loan, since we're on that topic, can you use a VA loan more than once, and what does that look like?
You can use a VA loan as many times. I mean, you can use a VA loan 20, 30 times. What really matters on a VA loan as far as using it multiple times is, say you have a VA loan now and you pay that mortgage off and you buy another home and get another mortgage, then you can certainly use that VA loan again and again and again. As long as you pay off the old loan and the VA gets that money, everything back, then it's just like starting off new again. So that's the big thing right there. As long as you're not going into a foreclosure or bankruptcy or something, and the loan is being paid off in full, you can keep on using it as much as you want.
Mm-hmm. All right, good information. So how long does the approval process take for a mortgage?
Generally speaking, when someone's applying for a mortgage and you have most of your numbers with you and you do the application right there, a good mortgage person can come and tell you right there at the beginning is that everything looks good at that time. You can say, dear Mr. and Mrs. Smith, everything looks great. Looks like, should be any problems with this loan approval coming up. Generally it takes a week or 10 days to get a loan approval, just depending how busy everything is. But if you have your debt to income ratios down pretty good, and you have, everything else, and you've got a good FICO score, it shouldn't be much of a problem. And you won't get the official approval right away, but the loan officers can pretty much tell you that, hey, everything's looking good. Don't worry about this, and let's just keep on going and getting all your paperwork.
All right. So how long is the application process?
Doing an application really just depends. Most of the time, when I'm doing an application for somebody, we can get everything done easily in 15 minutes or so from beginning to end. And then really after you do the application, then it's just getting the supporting documents and, like paycheck stubs and other documentations after the application.
Mm-hmm. Okay, and so it looks like we have time for one more, and this is a pretty good one. Can I get a mortgage if I don't have money for a down payment?
And that is a great question. And that, once again, going back to the VA loans, since a VA loan requires 0% down payment, and if the house sells for $250,000, you can get a VA mortgage for $250,000. And you really need, in that case, you need 0% down. And if you have money at that time, you can put it towards your closing costs. Now, if you're buying a house and you need a conventional loan or you get an FHA loan, then you really got to have that down payment, or you can't really move forward in the loan process at all.
Okay, great. Thank you so much, Dale. That is all the time we have for today. Thank you so much for joining us, and thank you for all of your questions. If you submitted a question that didn't get answered, don't worry, we haven't forgot about you. We will collect all of your questions, and we will get back to you via email or phone call in the next day or two. If you think of another question later on, please reach out to us. We can help you no matter what. You can contact Dale with the contact information here on the screen that you're seeing now, or you can always visit AAFMAA.com/mortgages to find out more about our products or to get in contact with us through there. Remember that we do webinars every 2 weeks, so that's twice a month, and you can always find new webinars or visit old webinars at AAFMAA.com/webinars. And with that being said, thank you so much for joining us today. We look forward to helping you out in the future. Get in contact with us always. We're here to help you.